There's a change in the air. Certainly that seems to be the case as we continue to move into the meat of the second quarter of the year. Inflation is one aspect which could well keep central banks on hold for longer with high interest rates. And the second, of course, is that ugly and rather dark corner of what's happening around the world at the moment, and that is geopolitics. Let's put it all together and work out what it means for the markets and introduce a regular guest here on IGTV from RW Advisory. It's Ron William. Ron, welcome.
Hi.
One of the things when we spoke about doing this interview, it all coincided with the eclipse, which I know is one of the outliers we talk about when looking at technicals. Let's put that to one side. I know we're going to refer to it a little bit later on, but that's just a little bit of a taster of what's to come. But I think the meat of our conversation really has to be around the risk that seems to be elevated at the moment, pushing volatility up and giving us a little bit of a pullback in some of these equity markets. So let me put it to you. How do we look at this, and what should we be looking at to give us an indication about where things might go?
So thank you for the overview in essentially what has been a changing season in the market. And we've been speaking about this for some time over the last 3 months, dubbing it the behavioral inflection point. But of course, the difficulty is timing that, particularly when the market's irrational and continues higher no matter what. Now we're finally seeing not the dispersion that we looked at last time in terms of cross-asset rotation. Now we're seeing the real thing. And on our opening chart, we can see the global ranking model, strategic long-term, tactical medium-term, active short-term. And when we last looked at this, gold and Bitcoin were at the top, and we had this mixed flavor of risk on, risk off. Now it's only gold that holds up, and of course that's been fired up on the back of FX debasement, but more geopolitical risk and just general defensive play. Now US 10-year yield is elevated and looking like it's going higher for longer, as you just mentioned, likely to the 5% handle historic level. We can see here the fall from grace, relatively speaking, in equity markets, risk on sentiment, USA in blue, shifting from top to down. Now, looking at the right side, we can see the relative outperformance of gold against cross-asset that maintains. There will likely be a short-term respite of about 10%, which is likely going to be a buy on the dip opportunity for the long term. The target of 2,400 has been met, and we're likely going to shoot higher for 2,700 with an extension likely for the 3,000 glass ceiling thereafter. Now, if we just look at the bottom right-hand corner, this is just showing percentage performance change since we last spoke. And you can see they're defensive right up the top, US 10-year, gold, copper, oil. So we get commodities also resurging in line with the view I've been talking about in terms of commodities being oversold and due a respite, but also the inflation story likely to support that in the coming months. And just look at the far right of the same chart, you can see a lot of the risk assets sub 2 standard deviation from their trend as part of that risk off and risk on rotation.
Yeah. Let's pick up on the inflation part of that, which I think is an interesting part of the story. As you said, we've just seen the evidence given to us by the US Treasury yield curve rising. And indeed, of course, this is yields across the world. Here in the UK, we're getting the same sort of thing, or have had. In Europe, not to the same sort of extent, but nonetheless, it is a question of seeing these higher rates. Big question about how long it's going to be. Give us some more information on this aspect of the thesis.
Well, certainly it's hotter than expected, and this has been a debate for a while, particularly because the market has been reasonably optimistic, both about macro economic growth in the US being robust, as well as the potential and so-called Fed dovish pivot. Now, we've been waiting, sitting on our hands all this time for several cuts on the back of inflation already halving from the highs, and lots of transitory signals suggesting that things were going to get better. But as we can see, we're still in this early stage surprise to the upside, hotter inflation, which chimes with the analog that we were working on before, inflation 1970s, different macro backdrop, but the pattern rhyme is similar in the sense that we had 3 waves of inflation with the next bigger one ahead. Now, just to take a step back, the chart on the left, figure 1, shows the crowd wisdom. for sentiment positioning on soft landing. So the prospects of the Goldilocks economy being back here and all being well, happening for the third time, and in American baseball terms, it could be the third strike and out. What tends to happen from a behavioral point of view when we get it wrong, and sometimes it's for good reason, just because data gives us a positive surprise in macroeconomics, we tend to double down with our or flip-flop the other way, and increase our optimism maybe over and above what we should. And what that tends to do is create an inflection point, hence the behavioral inflection point theme that I've been speaking about for some time. And I think now the evidence is weighing in, most notably because the wild card, according to investor sentiment and of course headline news, has been the geopolitical risk premium, which remains with us. And for years, we've had this now with Russia, Ukraine, Middle East with Israel, Gaza, and now Iran. And then there were some concerns, of course, on US, China with the Taiwanese elections. But essentially 54% of investor surveys by Goldman Sachs and other investment banks and some talking heads from various funds have also said the same thing. This is top of mind. It's a wild card, unpredictable, and it certainly is bringing back fear to the market, which was already obsessed about macro policy. That's now unwinding, and we're starting to look at other risks that need to be mitigated.
So the big question is, what's the roadmap looking like from this point?
Well, this is always the big question, where next? And this is where certainly tactical and chart analysis is useful. We always combine it as part of a holistic global cross-asset macro tactical framework, and historical analogs are useful in that realm. And here we're looking again at the party like it's 1999 until the music stops. So this is the NASDAQ price chart showing the exuberant markets of 99 compared to now. But the difference since we last spoke is that yellow line, which is the current market, has not just elevated into the red box, the predicted peak one, but we're now enrolling over stage, making a new marginal swing low. Essentially, this is likely part of a plausible historical rhyme, which in roadmap terms is a three-stage pattern: a fall, oversold rally, so that's yet to come once we get further fall ahead, then the rest of the fall. And that chimes in with a range of different cycles, including ones that we'll speak at in a moment, but also negative seasonality from May, sell in May, go away, and also the event risk yet to come, US elections in November. I do want to remind viewers also, just there in the top left-hand corner, the magazine cover indicator seems to be vindicted again, especially when you get a double headline news in The Economist barons. It's just particularly print media, when they do get very bullish, and these things tend to turn around very slowly, that's a contrarian indication of sorts, and it doesn't work all the time, but this may be one of the times that it does prove useful.
Yeah, interesting enough to look at that left-hand side of that chart. You've got those peaks and troughs and peaks and troughs. How sure can we be that we're at the top? I think in your next slide, you look at the S&P 500. We know about the pattern that we've seen. It's went into 2024 with a massive acceleration. We've seen a really positive upside. How sure can we be we are now at the top?
So no certainties, it's always based on probabilities, but we mustn't tell the market what it's going to do next. We must wait for the market to decide. And so waiting for the price confirmation is always going to be key. Often a leading indicator in its own right, but we have to have our biases in check. We need to allow for confirmation and follow through. The key technical pattern when we last spoke is a distribution phase, which is what we're now seeing. We're getting the rollover. We need to wait for a follow through, especially with the markets being so fickle, lots of false signals, and most of the surprises have been to the upside, in all fairness, in terms of the risk on sentiment. Now could be a change of season and sentiment. And on this chart, another technical signal which I think is quite useful for viewers to keep in mind is one called the throw over signal. That's when markets are super strong, irrational and exuberant, and essentially they overshoot any kind of trend or technical resistance, but in doing so, it usually breaks out, fails, and then rolls over. And that in itself is probably one of the strongest false signals to trade, because if it does confirm, it usually squeeze out a whole lot of leveraged long positions, unfortunately for them, but it's part of the game theory of markets that then opens up a hedge or short opportunity to the downside, particularly when the market's been strong for long and is overbought. We have three headwinds that are now unwinding: extreme momentum, rotation fragility, as we can see there on the top right-hand chart, deteriorating breadth, halved in size based on the tactical 50-day average. When we last looked at it, we had resumed higher again, but now it's a material breakdown from 85% of stocks in the S&P 500 above the 50-day to now sub 30, and we have other trends also unwinding. And then, of course, the cycle side, that's the chart on the bottom right, figure 3, mathematical cycles based on spectral analysis from the Foundation Study of Cycles. This was a very difficult chart because price was diverging from time predictions, price up, time down. Now we're in the second phase of that cycle model, predicting the downside that we're now seeing, and this now chimes in with the negative seasonality of May onwards.
Yeah. You mentioned breadth in the market. It's interesting looking at some of the individual core members of that narrowness we've seen of the rally that we've had in Nvidia. I know it's in the next chart, and it's interesting to watch what happens there. I mean, do we see a similar sort of sell-off in some of these big companies that have made so much progress? What should we be aware of for a stock like Nvidia?
Yes, well, in that the macro and fundamental story can remain strong for months and years ahead, but when things are too strong too soon, then it is technically due a healthy correction. And certainly in a late cycle rotation, as we're now seeing, and we still have to wait for follow through and further confirmation, Nvidia would be the poster child stock to unwind. And the big issue here is that Nvidia can have a healthy correction. But if it does, this is the general in the military field turning back in market metaphor terms, and having a big high beta impact on the market. So if there is a wobble on Nvidia, watch out on the underlying index, because we'll see bigger moves there. Nvidia is allowed to correct because it's just had such a parabolic rise. And the poignant theme headline, could the parabolic rise be eclipsed, given that it's in time with the eclipse season? And that's a grand finale conversation for us.
Well, let's pick up on the scientific casual model, as you put in here on the top right-hand corner. How do we look at this from a technical, analytical point of view?
It's simply behavioral impact. And the causal model there on the top right-hand side shows a scientific causal model developed by Dr. Campion, who's a professor at a university here in the UK, where I'm now back to studies. And essentially, in his own model, he shows that there are macro implications from the sky above. We're just talking about simple solar or lunar impact from geomagnetic forces, but also there's a psychological side. Psychologists talk about the feel-good factor that we get from watching these natural phenomena that tends to be positive both for our sentiment and for the markets. You can see there figure 4 just in the bottom right-hand side showing the statistical evidence of this. Every time we get a solar eclipse, typically it's twice a year, the market has been positive, but there are outliers. My caveat is nothing standalone works all the time, particularly something that is a little bit more exogenous and different and unique. In this case, it's as with all indicators, we're looking at behavioral sentiment, the market cycle itself in terms of macro and tactical, and then potential event risks that may exist. And so right here and now, sentiment has been so strong. So what that it can do is sometimes these natural phenomena can shift us to that final extreme before we then make decisions as to how to trade and invest. And essentially, that's what we're seeing on the chart. You can see the signal both into price resistance, but also time confluence, time based on cycles. You can see that there's a geometry cycle I put on there titled 360 cycle, as well as the natural phenomena of the eclipse, which many of us are in cosmic awe of, but potentially changing our sentiment with these irrational extremes that we've been at for some time.
Yeah. Ron, thanks so much indeed. Great point to end on, the fact that as technical analysts, we need more confirmation, as much confirmation as we possibly can about our expected moves. Thanks indeed for joining us.
Thank you.
It's a pleasure. Ron William from RW Advisory. Want to catch up with more with Ron? Join him on his LinkedIn page.